Hi, this is Rob Barnes with Integrated Insurance Consulting. In 2 short years, in the start of 2026, the cost of dying will be going up for many high net worth individuals. This is due to the federal exemption decreasing from 13 plus million down to around 6 million in the start of 2026. A lot of estate planning can be done between now and then to minimize or eliminate this exposure. Estate planning helps assure things go as planned during your life and after you die. You may need the help of a variety of professionals, including accountants, lawyers, comprehensive planners, along with life insurance and charitable planning experts. Estate tax planning requires different thinking. The axioms of estate tax planning tell us it's not what you make that matters, it's what they keep that matters. They tell us not to die the richest guy or girl in the graveyard, gift, shrink, freeze, or leverage your assets. You want to minimize bad assets to die with and maximize the good ones. You see, the estate tax laws, in essence, tell us we have to contribute to society if we've been successful to a certain level and above. You can do this through social or personal capital. Your social capital will be the estate tax that you pay, and you'll have no say in how it's spent. Your personal capital is what you might direct to qualified charities in lieu of paying estate taxes. Estate planning specialists will tell you there's two estate tax systems, one for the informed taxpayer and one for the uninformed taxpayer. The less you know, the more the IRS takes. But hold on, knowledge itself is not power. It's the application of knowledge that's power. So the less you do, the more the IRS is going to take. A comprehensive estate plan for persons with large estates must incorporate one or more of these strategies. You use techniques to reduce or shift the value of assets. Implement programs which take advantage of the income, gift, and estate tax deductions for transfers to charity. And some will leverage cash gifts through the purchase of life insurance held in ILETs. But it's a lot of work to get from one end zone to the other. On the left, if you do no planning, you'll have no say in your social capital and you'll pay a maximum tax. Few people will get to the other end zone of paying no tax because they won't self-direct their social capital to organizations like churches and charities and foundations. It's a lot of work to get from one end zone to the other. You have to create living trusts and power of attorney and healthcare powers of attorneys. You need to pick your guardians, trustees, executors. You need to make lifetime gifts and have an irrevocable life insurance trust, spousal lifetime access trust, perhaps buy life insurance, have a qualified personal residence trust, make sales to intentionally defective grantor trusts. And for even higher net worth people, they may use family limited partnerships, family LLCs, grantor retained annuity trusts, strategies like private split dollar and premium financing, and lots of attorney work and attorney fees. But here you are, you're in the red zone, you're ready to score, and all you have to do to avoid all tax is give the rest away to charitable organizations that you care about. You may use charitable lead trust, charitable remainder trust, or even create your own family foundation. A lot of people won't do all that work for many reasons. So what do you do in football when you want to score big and fast? You throw a bomb, or what they call the Hail Mary. So I want to share a quick overview of John and Mary. They happen to be a couple in Illinois with an $8 million estate. 3 million of that is in John's IRA. And so what we discuss simply is that qualified money is the worst asset to die with. And the reason being, when you're exposed to estate taxes on a high net worth individual, it becomes income and estate taxable for your heirs. And so one quick maneuver that John and Mary can do to substantially adjust what tax they'll pay, leave the IRA to charities that they care about. And they happen to be involved in their church and a few other charities that they care about. If they leave that asset to charity, they avoid all the taxes on it, both income and estate. And they're going to replace the asset with a wealth replacement trust, which is nothing more than an irrevocable life insurance trust that owns a second to die life insurance policy. that policy will be designed to leave what the kids would have gotten net of taxes. So the kids will be equal, the charity will benefit, and they'll cut Uncle Sam out of some of the social capital. One thing that's going on today for some high net worth individuals is they're continuing to do Roth conversions. And that might be a good income tax planning strategy, but it isn't necessarily a good estate tax planning strategy because the asset is still in your taxable estate. And it's about getting things money that you don't need to live off of or control outside the estate. So this might be something that some high net worth individuals can look into and better adjust their future exposure. People don't always need life insurance. What they need when they're exposed to estate taxes is liquidity. And there's a cost to liquidity that's often misunderstood or miscalculated. Do you have enough cash to pay the estate tax 9 months after the second death in a married situation, so that you can pay the tax man and be done with it? And if you did, you might have some opportunity costs of keeping so much money in cash. And even if you did have it all liquid, there's no leverage there. You're spending $1 to pay $1. For those that don't have the liquidity, they either have to borrow or sell. If they borrow, they've got to pay it back plus interest. And you never know exactly where the capital markets are or the loan interest rates are. And so you're paying $1 plus interest back for that tax. For those that need to sell, what do you do when you sell something fast? You have to discount it or the fire sale goes on. For those that have a family business or perhaps illiquid assets like a portfolio of real estate, selling's not an option. You're trying to avoid selling, and so you have to come up with the tax in one of the other options. And that's where life insurance might be utilized by those people with more illiquid estates, because it's leveraged cash with timely delivery and a known outcome. If you have a guaranteed policy, there's no risk. It's going to pay off when you pass, and the cash will be there for you. And often in a life insurance policy, you pay pennies on the dollar, so there is leverage in paying the tax. So even those with liquidity, they might utilize the leverage and tax benefits of life insurance. So why do high net worth individuals use life insurance? It's simple, it's easy, it's a known outcome. There's tax advantages because it grows tax deferred, it pays out income tax free, and if owned properly outside the estate, it's estate tax free as well. It provides tax diversity, protection from creditors and predators. So this is Rob Barnes with Integrated Insurance Consulting. I hope that you reach out to your financial professionals in order to start looking at what estate planning adjustments you may do, because these new lower limits might now expose you to federal taxes that you haven't had in a few years. Thank you for listening and enjoy the rest of your day.